So good afternoon, good evening, good morning, depending where you are. We have 600 people who've actually registered for this event, so very crowded house. Only 500 people will be able to access, so if you start hearing knocks on the door, they may be the 100 people who are trying, but as we know with many of these events, there's a big dropout rate. So anyway, full house, really happy to welcome you all to the Institute for Innovation and Public Purpose, which is hosting this event at University College London. Which I direct the Institute, and we're extremely happy to be hosting this event because the discussion will go to the heart of what we're interested in, which is to connect our understanding of how value and wealth is created to how it's governed and how it's distributed. Too often, we have these conversations in completely separate zones of economic theory and economic policy making. So I'm very much hoping that tonight will be quite a interesting and heated, hopefully, debate about what we need to do to actually increase our ability to steer the economy in ways that we actually produce the kind of growth that we want, which is hopefully inclusive growth, innovation-led growth, and sustainable growth. And I'm really happy to be hosting this evening for Thomas Philippon to discuss the themes from his new book, called The Great Reversal, How America Gave Up on Free Markets. And I must say that in preparation for tonight, I took off my shelf all the hard copy versions of his articles, which I read in writing my own book on value creation, and value extraction. And one particular article, this is very weird to be doing this on screen, but here we go. Finance versus Walmart. Why are financial services so expensive? This article is how I got to know Thomas's work, and I've been a big fan ever since. And I'm going to bring in some of that thinking later in our discussion. But just to introduce Thomas, he's the Max Hayne Professor of Finance at the Stern School of Business at NYU. He was named one of the top 25 economists under 45 years of age. Are you still under 45, Thomas? We don't know. Time's passing.
Barely, until the end of the week.
Sorry?
Just until the end of the week.
Okay, so we'll say happy birthday before the night finishes. So he was named one of the top 25 economists under 45 by the IMF and won the Bersaner Prize for Best European Economist. And I'm really happy that we're also joined by a colleague of mine at University College London, Professor and Sir Richard Blundell, who holds the David Ricardo Chair of Political Economy at UCL. And this is very appropriate because all of you who know about the debates within economic theory about rents and monopoly, there is, of course, the Ricardian theory of rents, which Richard might talk about in his part of the evening. In 2014, he was awarded a knighthood in the New Year's honors list for his services to economics and social science. He is currently, actually has been for quite a long time, since 1986, the research director of the Institute of Fiscal Studies, and he's the lead editor of a very important review that is currently happening called the IFS Deaton Review on Inequalities in the 21st Century. And it's a very important theme for this evening, where we will be asking ourselves when and how is monopoly power in fact bad? If it's not increasing inequality, if it's not hurting innovation, then who cares? If it's instead related to these structural problems in the economy, then we should all care. And not just economists and policymakers, but of course the public as well. And the reason I was saying I was so happy that the Institute is hosting this Zoom webinar this evening is that our work, as I mentioned in the beginning, really tries to go at the heart of bringing the concept of directionality of growth to the core of how we think about political economy. Too often, even now with the COVID crisis, we think about the rate of growth, what will happen to unemployment, what will happen to businesses' ability to create wealth in the economy. And not enough do we ask ourselves, what kind of growth are we actually achieving? What kind of employment, what kind of innovation are we actually steering our economies in ways that actually, for example, produce more innovation-led, investment-led, inclusive, and sustainable growth. And I'm really hoping that our discussion will go to the core of that. I also want to say, given that I mentioned that Richard holds the David Ricardo Chair of Political Economy, that my own kind of trajectory into this area was very much from Joseph Schumpeter and his thinking about rents and monopoly. And it's quite interesting that when people think of Joseph Schumpeter, they think of his work on innovation. And actually, most of what Schumpeter said on innovation, including the concept of creative destruction, was already in Karl Marx. And he sometimes admitted it. What was very original in his work was actually his theory of competition. And I think it'll be very important to come back to that tonight. What is the kind of benchmark theory of competition through which we are then judging the problems around monopoly power and corporate power? Because what Schumpeter said was that the problem with the notion of competition in kind of mainstream neoclassical thinking is that it was a benchmark through which we then looked at reality, oligopoly power and monopoly power, which we'll be talking about this evening. But that benchmark actually had very little role in the kind of key driver of growth under capitalism, which was in fact innovation, which then constantly creates disequilibria in the system. It creates constant differences between companies. So the notion of the representative agent was something he critiqued, as well as the notion of unique equilibria. But I'm just saying this because I think that we should come back to this afterwards, and I will be provoking both Richard and Thomas on this. Is the problem that we have imperfect competition, and so we just need to get rid of those imperfections as some sort of transient nature of capitalism, which we can compete away? Or is the problem that we also currently have a problematic notion of the benchmark of the type of competition that we actually need, and the way that we actually measure oligopoly and monopoly power is around this fictitious notion, which not only doesn't exist in reality, which we all know, but also doesn't capture some of the key drivers of growth in our capitalist economies. So anyway, I'll get to that later. And without further ado, what I'm going to do is allow Thomas now to give a presentation. He has a great slide deck for 20 minutes. Following that, Richard will give a response for 10 minutes. Then we're going to have a bit of a discussion, hopefully interesting to you all out there, because I'm sure that Zooms are less interesting than, or feels less interesting than a nice heated room with 500 people sitting closely to each other. And then we're going to have 15 minutes of Q&A, which Rowan is going to administer for us, because it is quite complicated with this amount of people on Zoom. So Thomas, without further ado, please feel free to begin.
Thank you very much, Mariana, for the introduction, and I look forward to yours and Richard's comments. I'm also sorry not to be in London. We had scheduled a trip to London, a book tour, and I always love coming to London, so I'm disappointed not to be able to be there physically, but I'm glad that we can nonetheless talk about this this topic that I think is important and somewhat underexplored. So let me just give you a tiny bit of background, and let's start with the title. So why did I call the book The Great Reversal? To some extent, it corresponds to my personal experience coming to the US. I was a student. I grew up in France, as you can hear. I went to school all until the end of my undergraduate studies in or near Paris. Then I went to London for 1 year before going to Boston to do my PhD at MIT. So I landed in Boston around 1999 as a PhD student, with a small stipend. And so I was kind of price conscious, and I was looking around at the thing I could afford. And very quickly it became clear to me that the US at that time was a place where things were cheap. Not everything, but many things were cheap. And of course that is surprising, because the US was and still is about 20% richer on a per capita basis than Europe. Therefore, you would expect, all else equal, prices of non-traded goods to be more expensive in the US. And that was not true. Many things were actually cheaper. Domestic airline tickets were cheaper. Telecommunication was much cheaper. Of course, I was there as a student, so one of my first goal was to buy a laptop. Laptop were at least 30 or 40% cheaper than in Europe, and then get online, get on the internet, get some data, read papers. Much to my surprise, I realized that connecting to the internet from home was essentially free in the US. You had to buy the modem, and you need to have a phone line, but that was it. That was it, because local calls were free. So you could dial up to your local server as long as it was in the same zip code, and you wouldn't pay by the minute. And remember, that's a time before broadband where you sometimes did a few hours to download a file from the internet. So that made a big difference. Now, why was it free in the US? Well, because the US had a very competitive telecom sector where, because of this competitive process and also because of smart regulations, local calls ended up being free. Now, in Europe, it was not the case, which meant that in Paris, if I had to spend time on the internet, I would be charged by the minute, which was prohibitively expensive as a student. So this is the US that I discovered exactly 20 years ago. And if you look at the same data today, you see not just that Europe has managed to catch up in a sense, and also deregulated some of its industries, and somehow managed to have the same prices in the US. In fact, Europe is now much cheaper than the US. So this is the exact prices that struck me as being cheap in the US in 1999, and this is the data for 2018. Okay, so this is the broadband cost per month, normalized so that we are comparing contracts that are the same quality. In that case, mostly the speed. Okay, so think of this is the same speed, the same broadband connection, and you just look at how much you pay per month. To give you a sense, every single developed economy is somewhere between $30 and $40 per month. Some places are much cheaper, like India is much cheaper. But if you look at economies with roughly similar GDP per capita, then from France to Japan to Germany to South Korea, everybody is in the $30 to $40 per month rate on average. Of course, you can find something cheaper if you look. In the US, it's 68. Okay. If anything, these differences have grown since then. If you look at cell phone prices, it's even worse. Okay, so on average, Americans are paying 2.5 to 3 times what people in Europe pay for exactly the same plan, for exactly the same phone. So what's happening? Is it just this industry? Is it more generally the case? What's driving that? Well, so let's keep looking at the telecom industry. As you can see on this figure, 2 things happen. The markup has increased and concentration has increased in the US telecom industry. So the markup is in green. It's measured on the left, and it went. So this is a change in the markup since 1990. So you see in the 90s it was relatively flat. I mean, it goes up and down, but there is no trend. This is when I got in the US around 2000. So this is a time where the industry is not very concentrated. The markup is relatively low. But then following this period, you see like a 15 to 20 years, essentially uninterrupted increase in profit margins in the telecom industry. And this is pretty much higher prices year after year. It came together with a sharp increase in concentration. All right, so CR8, measured on the right, again, that's the change over time. So 0 is the baseline. This is the change in the market share of the top 8 firms, right? CR means concentration ratio, 8 for top 8. So that has increased by, something like 0.4, 0.3, 0.4. Okay, that means the market share of the top 8 firms has increased by about 40%. Okay, if the top 8 firms used to account for, say, 30%, now they account for 70% of the market. Okay, so higher prices, higher margins, and concentration. Now, is it just the telecom industry? So you can broaden the scope and look at the entire US corporate sector. So this is for the non-financial corporate sector. The finance industry is a slightly different beast, so I treat it differently in the book. So this is for non-financial corporations. You can see that profits over value added, so profit over GDP, if you want, hovered around 7%, with of course cyclical fluctuations. Essentially, every time there is a recession, the profits tend to fall, but they were fluctuating around something like 7% until the 2000s, and then something happened in the late 90s, in the early 2000s, where now the profit margins, they are still cyclical, but they clearly are moving around a higher average, which is around 10%. So what we saw in telecom is a bit extreme in terms of magnitudes, but it's by no means exceptional in terms of the direction. The same thing is true with concentration. So we saw rising concentration in the telecom industry. If you look at the entire corporate sector in the US, you can break it down by manufacturing and non-manufacturing industries. You have both on this graph, manufacturing in green, non-manufacturing in red. And again, same thing, this is the change in the CR8. Now, of course, you see the magnitudes are much smaller than the telecom industry. This is in part because if you want to do this calculation for the entire economy, you hit constraints about exactly how granular you can be. So some of these sectors are a bit too aggregated. But you can see that both in manufacturing and non-manufacturing sectors, we have an increase in concentration. In this figure, it's about 6 to 8 points from a baseline, which is around 20 for non-manufacturing. If you take on average, you can think of your typical industry in the US as having an increase in concentration of something like a quarter, which to translate into something easier to understand, imagine you had 4 large dominant firms 20 years ago. On average today, you would be down to 3. So these facts are not too controversial. There is some controversy because, again, it's sometimes difficult to define the proper market. So if you are focused on the antitrust part of the equation, some of this data is too aggregated. But by and large, these facts are, I think, well accepted. What is very controversial, on the other hand, is the interpretation of the fact. Okay, there is much debate about how we should interpret these trends. Now, at the risk of oversimplifying, I'm gonna call the two interpretations good and bad. Okay, so good concentration versus bad concentration. Good concentration corresponds to the case where concentration is essentially driven by the fact that the top firms, who to start with were already more productive than the rest, become even more productive. Okay, so if you have an industry where the leading firms, say the top 4 leading firms each had a 10% market share, then that's 40% together. And then the top firms, the top 4 firms are the ones also who innovate more and create more productivity growth. Then these firms, say, raise their market share from 10% to 15%. So and then what you see in the data is the market share of the combined market share of this top firm went from 40 to 60%. Of course, that is not a bad sign. It just means that these firms are working harder, innovating more. And so the concentration is just a consequence of that. And there's nothing to worry about. Typically, when you see that this type of good concentration, because it's driven by productivity, it comes together with lower prices, of course, productivity growth. And especially in recent years, almost all the time, it comes with a lot of intangible investment. Okay, the way efficient large firms become even more large and efficient is because they are able to make the right type of intangible investment, right? So intangible means software, platforms, branding, and this is in recent years become relatively more important. Okay, so broadly speaking, I would put all of this explanation into the category of good concentration. Bad concentration is the opposite. So the opposite means what? The opposite means that the reason the big guys are getting more and more market share is not that they become better, smarter, or hardworking. It's because they manage to protect themselves against competition. So when you see that concentration driven by barriers to entry, then typically comes together with high prices and low productivity growth. Okay, so it's not difficult in the US to find example of both. If you look at the retail sector and the wholesale trade sector, it's very clear that much of what's going on is good concentration. If you take the other extreme, you look at the telecom, like we did 5 minutes ago, you look at the airlines industry, you look at the healthcare system, it's clear that it's bad concentration. But that's just, a fraction of the economy. Everything in between is some kind of gray area. Okay, so the question is not whether it's all good or all bad. The question is, roughly speaking, are we seeing more of the good type or more of the bad type? Okay, and once we understand that, we can ask the next question, which is it technology or policy? So let me just start with an example of what I would characterize as good concentration. And that's the rise of Walmart. So Walmart, the big retailer, essentially started to grow in the 80s. You have the market share of Walmart on the right. And you see it goes from 0 to 60%. That's not a typo, right? This is literally 60%. One firm, 60% of the market. For that market is defined as big box retailers, okay? So it's a specific type of retail. It's still a gigantic firm, and it's an incredible growth from 0% to 60% of the market. But as you see, the green line is the profit margin of Walmart over time. So this growth came together with flat profit margins. So how did it happen? Well, Walmart was innovating a lot. It was investing tremendous amount of resources into IT systems, just-in-time management of its supply chains. And all these productivity gains, because the profit margin didn't rise, that's telling you that almost 1-for-1, these productivity gains were passed on as lower prices to consumers. Okay. And this, of course, created the growth of Walmart, but the consumers got a good deal. Okay, and I want to emphasize here, when I say good concentration, it's not taking a stand on the entire economy necessarily, because it's not the case that the growth of Walmart was uncontroversial. You can look at labor practices. You can ask yourself whether, from the perspective of inner cities or smaller cities, is it good if smaller retail stores go out of business? All these are valid questions, but that's beyond the scope of what I'm trying to say. My point is much more narrow. I want to see, at very least, I want to see that if there is concentration, I want to see that consumers get a good deal. Okay, and in the case of Walmart, I think it did. The other reason I really like this example is because if you look at what happens in the early to mid-2000s, Walmart was reaching something like 60% market share. As you can imagine, this did not go unnoticed. So regulators were worried. In fact, everybody was worried. Economists, antitrust, everybody was worried. Probably for the right reason, which is Walmart was becoming too dominant. So there was talk about what should be done. Maybe we should have an antitrust action against Walmart. Maybe we should do something against this market dominance. And somehow this didn't happen. And you see the growth started to flatten. And of course, we know the answer, which is competition came. It did not come from the industry where Walmart was registered, which was big box retail stores. It came obviously from Amazon. Okay, so the thing that people didn't anticipate there is that the competition for Walmart would come from Amazon. But this is exactly how capitalism is supposed to work. Okay, by the time somebody becomes too dominant, the way the system is supposed to work is somebody else, and usually from somewhere you didn't anticipate, is going to come and start competing. Okay, and today nobody thinks that there's an issue of lack of competition in that market. Okay, in large part thanks to Amazon. So I think it's a great illustration of the way capitalism should be working. And the only question is it what we see today? Okay, and what I document in the book, and you saw some of it earlier, is unfortunately no. I go through a long list of proxies and measurements in the book to talk about whether what we see in the data looks more like good or bad concentration. I look at profit margins, innovations, entry, intangible investment, productivity growth. So here is just a summary. Suppose you take all of these proxies, all of these measures for good and bad concentration, and you put them into a basket. The first one we call intangible driven concentration. That's the green line. And the second one we call barriers to entry type concentration. It turns out that in the data, these two very simple clusters account for a very huge fraction of the variance. So it's not that every single industry can be classified perfectly into one or two, but a lot can be classified that way. And these lines show you the prevalence of the two types of concentration over time. So as you can see, intangible driven investment and concentration has not disappeared. Roughly, it was increasing in the 90s and then sort of flattish in the 2000s. So I'm not saying it's gone away, but what's striking is the second type of concentration, the one that does not come with productivity and low prices, the one that comes with no entry, high prices. This is the one that becomes relatively more dominant over time. So my point is that on average, we used to have mostly good type concentration in the 80s and 90s. And today in the US, at least over the past 20 years, we've had more and more of the bad type concentration. Now at this point, the next question should be, okay, is it technology or is it policy? Because if it's technology, we might still want to do something about it, but it's going to be harder. If it's policy, on the other hand, we want to understand what could have gone wrong. Now that's a very difficult thing to do because you don't know the counterfactual. And that's why I think the comparison between the US and Europe becomes much more illuminating. Europe, to a large extent, has exactly the same technology as the US, with one exception, which is Google and Facebook, and perhaps Amazon to some extent, because these are industries that don't quite exist in Europe. So I'm going to exclude them for the analysis for the next 3 or 4 slides. So think of every industry except Google and Facebook. Okay. Now think about these industries and quickly realize that we have exactly the same planes, the same airport, the same cars, the same road, the same cell phone towers, everything is the same. Okay. So technology is the same. And it's of course not by chance because we trade and we exchange the technology. So there is no way the difference in technology can account for differences in prices between the two regions. So looking at what's going on in Europe then becomes interesting. And in Europe, what you see is starting in the mid-90s, a push to have more free markets. In fact, a break from the past, a break from a tradition of much more centralized state-dominated industries towards more free markets. It comes in the mid-90s. This is not by chance. It was by and large a consequence of the single market push in Europe, where we try to unify to have a single market. And that pushed countries either on their own or motivated by the European Commission to move towards more competition at the EU level and at the member state level. So this you can see in this wave of product market reform. So PMR, product market regulations, and these are reforms. So one means there is one major reform per country per year on average over this period from say 95 to 2005. To be more concrete, let me give you one example. It's a case of France. So as I was telling you in the introduction, France used to be expensive in terms of telecommunication prices, much more expensive than the US. If you look at this figure, this is just the relative price of communication services in France relative to the US. So it's literally the data from the World Bank and the international comparison of prices data. You take the price of telecommunication service in France, you convert it in dollars, you divide by the price in the US, and you plot it. That's nothing more than that. So France was about 10 to 15% more expensive than the US for communication services until 2011. And then in 2014, it was already 25% cheaper. So this, okay, from 1.15 to 0.75, that's a 40% drop in the relative price in 2 years. Okay, so it's massive. It's not a small industry, it's the entire telecommunication industry. So prices moving by 40% in 3 years is something you notice. What's even more remarkable is pretty much only one thing changed in 2011. That change was the license given to Free Mobile to enter the telecom market. So we used to have 3 main operators, 3 legacy carriers. And like all nice oligopoly, they were colluding and charging high prices. And a 4th operator was asking for a license and was being denied for at least 8 years, actually, under heavy lobbying by the incumbent to make sure that the new entrant would not get a license. Finally, in 2011, the regulators made up their mind and gave a license to Free, a license plus a step in so that they could enter the market. And Free entered at a price point which was half of what the incumbent were charging. So at that time, your baseline, unlimited texting plus gigabytes of data, your basic contract like that was around 40 euros per month, and Free entered at 20 euros per month. So literally half the price. Within 6 months, the legacy carriers realized that they were losing market share, so they had to match the price, which means that a year later, everybody was down to 20 euros per month, which means that even if you, as a customer, didn't switch, okay, even if you were not tech savvy and not trying hard to find the best deal, you benefited from this. And that was the massive drop in prices for consumers in France. Today, to give you a sense, that means that just that reform is probably saving something like 50 to 100 euros per household each month in France. This is a ginormous saving. if you broaden the scope and you look at all the countries and all the reforms, you get a picture like that. So this green dot counts the number of regulations that each country in Europe has compared to the US. The US is the red line. Each green dot is one country in Europe. So you see that around 1998, pretty much every country in Europe tended to have more stricter regulations than the US. And 1 year to the next, not much happened. So you wouldn't notice it if you just look at one vintage of data to the next vintage of data. But if you keep track over 20 years, you see a very slow but sure decline. So that at the end of the sample, for the latest data we have, many countries in Europe have about the same, if anything less, regulation than the US. So that's quite remarkable. If you want to go back to the markup, so what's the impact on prices? You see the one measure of the markup. This is the price of goods relative to how much people earn in the labor market. It's kind of flat for Europe, and you see the drift up in markup that we saw earlier in the US by about 7 to 8%. So let's try to translate that into numbers that we can relate to. So my estimate is that prices in the US, because of the lack of competition, means that households pay about $300 extra per month compared to what they should be paying. So if you take, so that's for the median household in the US each month. If you take all the household in the US over 12 months, that's about $600 billion each month of consumer spending, which correspond to rents. Then if you go one step further and you ask yourself, suppose we could dial back to a highly competitive economy like we had 20 years ago, what would be the impact? Well, if you do the math and you model the economy properly, then that would suggest that GDP would go up by about $1 trillion. Labor income would go up by about $125 trillion. Why? Well, because corporate profits or dividend payments and share buyback would go down by about $250 billion. Okay, so this is the cost of not having competition in the US economy. And this is, by the way, using conservative assumption about innovation. If you bring in innovation, you could even get these numbers larger. Okay, so that's where we are. What happened? I think that what's fascinating in Europe is it was mostly a change in institutions. It's the move towards single market and the political economy of competition that changed. What happened in the US, it's a bit more complicated. What we see over the 2000s is a slow dilution of pro-competition policies driven by corporate lobbying. And it translates into less antitrust action, but also creeping barriers to entry in many industries. And that shows up as excessive regulations, excessively licensing requirements that prevent small firms from entering, as well as predatory behavior by large incumbents. Just to conclude, this I think is part of what's going on in the US. This is lobbying expenditure over time. You can see the large increase in the 2000. The data after 2010, unfortunately, is not reliable because the reporting requirements were sort of dropped. And I don't think there is reason to believe that it really flattened. It's probably kept going up. But what's striking is, roughly speaking, and the data is for Europe is here. We don't have the same time series, but Europe lobbying expenditures today are about the same as they were in the US 20 years ago. But the US expenditures are 3 times today, or maybe 2 times today, what they used to be 20 years ago. So that's the big change. And that's driving some of these changes. So to conclude, the US used to be the land of free market. There's no question about that. But today, if you look at many industries, not all of them, but many, I think consumers get a much better deal in Europe. Thank you all.
Thank you very much. And we'll get to everybody's comments in a minute. First, we'll have Richard respond. And just to say quickly, I found very refreshing, and I think we need to talk about it more, this issue of bad versus good concentration. Of course, William Baumol talked about this when he thought about productive versus unproductive entrepreneurship. So patents themselves can spur what we could call Schumpeterian rents versus bad rents. And I think what would be very nice as people are also listening to Richard is if we keep coming back to that and ask ourselves, what is the underlying understanding of how production itself occurs in a sector, as opposed to maybe thinking too much about lobbying powers, which can always be seen as an imperfect problem that we can, again, counter with policy and getting rid of imperfections, the real need to go down to how does production itself occur? What is the way in which market creation itself occurs? And then to understand rents as part of that. So the classical economists, of course, talked about rents as unearned income, which required a real objective lens on production itself. So I'm going to come back to that theme later, but I want to hand over now to Richard.
Thanks, Mariana. Thanks, Thomas. Wonderful book, by the way. A book that really gets you thinking. What I'm going to do here is just go through some reflections on the book as I put them together rather hastily yesterday evening. But in many, many respects, Thomas's experience of the US versus, let me just check everybody can hear okay. Yes, versus Europe rings true to many of us in those distant days when we could travel between the US and Europe. In fact, I was also in Boston in the 1990s. I had rather too many thoughts. I mean, it's a very inspiring read. And so what I thought I'd do is put my slides together around, or comments, thoughts together around through three broad questions, Tom, are much rather bigger in a way than what you looked at in your talk, but driven by them. The first is just thinking through how competition lowers prices, improves innovation and productivity. So can competition does it? And of course the answer is yes, but it's a balance. And the question I thought of as you were writing and talking today was, well, has the US increasingly got the balance wrong? If so, why is the US so different? Is the US so different? We know US healthcare is horrible. It produces outcomes that are less good than many healthcare systems in Europe that cost 50% in overall input costs. And additionally, it has incredible inequality built into it. But that hasn't changed. I don't think there's any real evidence. There perhaps is a little evidence of market power increasing recently. Telecoms also now looks horrible. And I think Thomas on absolutely solid ground in looking at telecoms. But I want to look a bit more broadly in this discussion, hit upon some of those themes that Mariana brought up too. Are tech companies different? I want to think about tech companies a bit more. Second question, can market power lead to excessive inequality? In fact, it's interesting you raised the bad, good inequality, because in much of the work we've been thinking of in inequality, we think of bad and good inequality. Not all inequality is bad, and certainly not all inequality is good. So what is it that matters here? Is it higher prices? Is it excess profits? Is it poor service? Is it lower wages? Is it political capture, data capture now, or all of these? I should add that in the review we're ongoing at the Institute, market power is a really key part of that. And perhaps that is an interesting reflection on the increasing importance issues around market power have come into policy and mainstream economic thinking. And then finally, I thought, what's the appropriate policy response here? Is it that we need a new form of antitrust, or the US does at least, competition policy as we call it, regulation? Is it that we really need complementary policies? Our corporate tax is screwed up. Our political funding restrictions, are they just too weak? Have we just forgotten about strategic agglomeration policy? I like to think of the UCL DeepMind link up as a wonderful example of success there. And don't forget the labor market here. The fall in boardroom representation, for example, to many is thought to have changed the corporate governance and led to some of the excesses that we may think we see here. So the competition, innovation, productivity line. Yes, of course, incumbents can have too much power. We see this discussion, keep out new entrants, stifle new ideas. That's the kind of Schumpeterian effect we could come back to that. I'm very much in favor of that model, and have worked on it quite a bit myself. Keeping wages low, prices help. But of course, as Schumpeter points out very clearly, there can be too much competition. A good innovation will have a growing market share, at least for a while. I very much like the way Thomas in his book thinks about persistence of market shares as something going wrong, rather than market share itself. So moving from a static to a kind of dynamic concept there. But maybe it's become harder for authorities to get the balance right. This is what a question I wanted to put to Thomas or General. Is it that tech giants and digital platforms, globalization, complex price contracts, they're all things that we think of are relatively new. Is it that they make it hard to measure the costs, perhaps due to corporate lobbying? I'm going to keep talking about that. Perhaps due to national pride, nationalism, or something like that. I hope everyone can still see and hear me, because I just saw a little signal. Let me know, Mariana, if it's not clear. So is Europe so different? Europe saw a positive impact of the single market program, for sure. I worked on that myself in a Schumpeterian concept, exactly. And we showed, and people know, that EU institutions were improved. The external competition led to an increase in productivity and innovation. EU institutions were put above national interests. I think that's absolutely key here, actually, and Thomas gives good examples of that. But market shares and lobbying has increased, labor shares have fallen, and productivity has stagnated, just like everywhere else. Low investment. Is it really that the finance industries has too much incumbent power in the UK and perhaps elsewhere? So let's not get complacent about Europe. If I go back to the US, I always like to look at this list, and it's quite a list, right? You see, this is the top wealthiest from Forbes, I think last year. Look at all the names there. There's only one inheritance, that's Jim Walton. He's inherited the Walmart empire with quite a lot of innovation actually during his time. All the others are what we call innovators. They're names we know and we use, and to some extent we think have benefited us. In fact, we still hear in Europe the cry, you know, why no Google? Why no Apple? Why no Facebook? Why no GAFAMs in Europe? So are these good innovations that have gone bad? And note too that in COVID, the two entrants we use all the time, this one, Zoom, and the one I use at the office all the time, Slack, are both Bay Area-based companies. And so there is something interesting about the US and its inevitability. But still, the top wealth all feature companies with good innovations, I think. So there's a good, good innovation, I'm going to call it. But something's gone bad, perhaps. There's evidence that they've become clever at killer acquisitions, a point that Thomas makes great in his book. Facebook with WhatsApp, stifling innovation in a way that's hard for standard antitrust to get a hold of, and I'll come back to that, reducing productivity. A focus now more on lobbying for favorable regulation and taxes, and I don't think we can ignore the importance of lobbying actually here. But there's also evidence, and I think this is where the grey area is, of efficient superstar frontier firms. Perhaps it's the GAFAMs themselves. Big isn't necessarily bad. In fact, if you look, and a lot of good researchers have looked at this, in those kind of industries, the median firm in the industry has stable, if anything, declining markups, lower productivity. The problem, they would say, is the left tail is horrible. The left tail is low productivity, and really maybe the big ones aren't big enough, or at least we need to do something about the productivity of the lower tail. And I think that's a competing idea here that we need to think about. It certainly poses challenges for competition policy. Do we need a new approach? Jean Tirole would say, yes, we need a forward-looking approach, focusing less on breakup and more at reducing risks around digital platforms, and thinking about revising the kind of thresholds that we have in vetting for investigations. And what about the market share when we've got China? It's far from just a US issue. So just the kind of last third question, but bringing in inequality here. Can market power lead to excessive inequality? Well, US inequality is certainly high, and wealth inequality in the US is even higher. But top inequality, and we saw the top 10 there, in the US is driven to a significant degree by innovators. It's not just those top 10. It really is in the top 1%, a huge proportion of entrepreneurs. That's less so in Europe, particularly in the UK, where if I look at the same top 10, you'd find real estate, a lot of inheritance, and a big chunk of finance. Remember, only one of those 10 were in finance, Buffett. So does it mean to say that good inequality, this is good inequality because it's innovative? Of course not. We could still have market dominance and monopsony. So this link between inequality and innovation and entrepreneurship doesn't mean to say, and I guess this is Thomas' point here, that there's no role for intervention. Market power translates, we know, into high incomes and wealth. Excessive market power implies excessive rents returns. That's kind of clear. But at the same time, we've seen firm owners face relatively low taxes, in fact, relatively falling taxes on capital gains and dividends. And this is why I think there's a balance of policy here to be thought of. And I think it's key in thinking about high incomes and the returns and rents here. Then finally, inequality itself can hinder growth and innovation, of course. It can also influence the direction of innovation. Think about the financial and non-financial barriers to entry that we worry about all the time. If we've got too much inequality, where are the new Einsteins, as the paper by two of my great colleagues, or previous co-author, John Van Reenen and Raj Jetty actually have written. And what about direction of skill? We know now there's a lot of emphasis now in having technical change that is pushing more towards labor, perhaps more towards green. With high inequality, it's the consumption of the rich that drive a lot of innovation. So these are very importantly wrapped together. So it's a great book. Should we be optimistic? I'm usually pretty optimistic, but I had some trouble with this. So we certainly got this evidence that markups and market power have grown, at least in some key sectors. I think the telecoms is really clear. I'm not quite so sure everywhere else, but competition and innovation has declined, inducing lower productivity and excess inequality. Do we need, just to wrap up here, a new approach to antitrust, competition and regulation? Is that where we should go in thinking about responding to these, this lack of competition and excess rents? Is it that we need more aggressive merger investigations, changing the threshold for vetting? You remember, WhatsApp didn't even get through the threshold. It just went under the radar because these companies are worth nothing. But they're worth nothing in terms of turnover. They're worth a huge amount in the actual value. So if they did value-based thresholds, they would have all been investigated. Focus on data, it's all about data. But you might think you get the thing for free. In fact, they should be paying you because they're using your data to guide advertising. And that's where the money on these platforms are being made. We need more international coordination, and that's a really, really hard thing to see happening with Brexit, China, US. In that side, and I think that's true at tax side as well, the coordination things are really worrying. An antitrust policy, I think, just the final point, won't be enough. It's a real balance of policies. We need to think about corporate taxes, capital gains, dividend taxes, lining those up. In fact, the review before the Deaton review, the Merley's review, said exactly we should be lining these up. And we should think about strategic policies, agglomeration, university research. I guess that's in my self-interest, but still, I think it's important. I do think lobbying is important, and I think the role of the boardroom, as we now know that in Germany, where there are legislative workers on boardroom, you know, the direction of corporate policy and corporate governance, at least, is rather different. And I think there's now real evidence that that's important. So, finish. Should we be optimistic on this side of the Atlantic? We saw a lot of pro-Europe there. I'm not so sure. The GAFAMs are here. You know, they're here and we don't even get the rent from them. They're here and we use their services. There are huge information issues and issues around democratic accountability that we see in elections and other aspects. And after COVID, well, you know, what's going to happen with COVID? COVID's obviously focusing in on the old inequalities. It's certainly highlighted new inequalities about working at home and all that, not the thing we should be worrying about here. But think about the consolidation of power by the large firms. The large firms are going to be the ones that survive, and they're in an extremely strong position to consolidate their power. And I think this could kind of turn back to all the issues that Thomas has raised. So a wonderful book. You know, you can see it inspired a lot of random thoughts from me, but there are a lot of fun thoughts as well. So I look forward to the discussion. Thanks very much, Thomas.
Thank you, Richard. Wonderful set of comments. And of course, Thomas, I'm going to ask you to respond to some of those, but just also to provoke a bit more of a dynamic discussion. First of all, just to say what's great about turning your video off is you can drink wine, and then when you turn it back on, you pretend you're drinking tea. But one of the comments was also that we should all share what we're reading in the back. So I took, as I read that, as one of the 16 Q&A so far amongst the originally 300 participants we have, I took down 2 books from my bookshelf that had to do with this conversation. One is by Helen Boss, a wonderful economist who wrote a book called Theories of Surplus and Transfer. Here you go. Thomas and Richard, I'm going to ask you to share books as well. And another one by John K. Galbraith on economics and the public purpose, where he talked about how the state itself can get so captured and end up serving the interests of monopoly power as opposed to the type of growth we want. And his son, Jamie Galbraith, is on our advisory board and is going to try to join late in the discussion. Anyway, one of the things that I think is interesting is talking about different sectors. And I really appreciated, Thomas, the way that you kind of got us thinking about how tech might be different, for example, from finance, which again, I mentioned that great article you wrote about the lack of Walmartization of finance. We haven't seen the kind of effects of the economies of scale in terms of reduction of fees and price cost margins in that particular sector, and how in some ways the way that production itself occurs in different sectors matters, and how we understand the ability of corporate power and monopoly power to have its effect. And I want to come back to that because I think it's a very important distinction, and I raised this in my book on Value of Everything, that we've sort of lost this objective lens in thinking just about kind of individuals making their decisions, consumers maximizing their utility, firms maximizing their profits, workers maximizing their individual decisions of leisure versus work. Some of the more objective characteristics of how intermediation itself occurs and possibly also creates rent extraction in particular sectors, that requires an analysis of production itself. And of course, in the tech sector, which Richard was talking about at the end, where actually prices aren't that important, you know, Shoshana Zuboff, who gave one of our lectures last year, says, you think you're searching Google for free, but actually Google is searching you for free. Something that Tim O'Reilly and I also talk about in terms of algorithmic rents. I just wanted to bring the discussion back to this kind of intersectoral difference, because otherwise it's too easy to think that policy can come in this kind of aggregate way and that we can create generic institutions to reduce monopoly power without actually paying attention to what is occurring sector by sector. So that's something I'd like us to come back to, but first also to give respect to Richard's wonderful comments, just for you to react both to Richard's comments, but also to the sectoral diversity. And within sectors, we shouldn't forget there's firm diversity. Not every firm operates the same. You mentioned share buybacks in the pharmaceutical sector. You know, not every firm uses share buybacks. Some do, some don't. So in terms of policy, how can we actually tilt the playing field towards rewarding those types of behaviors we think are important to get us the kind of objectives in terms of directed growth that I talked about in the beginning. Anyway, sorry, Thomas, come back to us reflecting on
Thank you.
Richard's comments.
So, I don't want to be too long. So I'm just gonna take two main points from what Richard was saying. So the first one is just to be absolutely clear. I am not saying that the US is doomed, and I'm not saying that Europe can become complacent. I think if you think about the big picture, what drives growth and what's the strengths of the US, it's not very complicated. The universities, with all the ecosystem of innovation that tends to cluster around these universities. Also the private labs. So university knowledge centers, finance, including the ecosystem in California, but also more broadly speaking, financial markets are very willing to reward young companies with large valuations. And then you have product and labor markets. So I think these are the four important pieces of comparative advantage of the US. My point is 20 years ago, the US had the four of them. Now the US is left with only three, because I think that product market competition is much weaker. But universities and the financial system and labor market to some extent, although labor markets, I think we should really put healthcare part of the labor market. And I think if you do that, then that doesn't look so efficient anymore. So I don't think there's any sense that the US is, is doomed or even likely to perform less well than Europe, because it still has this comparative advantage. Now, on the flip side, of course, Europe should not be complacent. In fact, there's an interesting question as to, that's a discussion I often have with Luigi Zingales, whether we should think of Europe as just being 10 years behind the US. So we just started the regulation later. So we now are at the peak of the post-deregulation, but then monopoly power is going to creep back in. Or whether Europe did really something right for once, and we're going to keep that going. On that specific point, I am optimistic. In fact, I would be very optimistic, except for one caveat, which is China. I think China can be a big disruptor there. I'll come back to that because of the political economy issues. Absent China, I would be very optimistic, because if you think about the reason Europe went towards free market, they are very logical. It's just because that's the Nash equilibrium. Nash equilibrium don't change unless you change the institutions. The reason the European countries went towards free market is because they realized that once you have a single market, the best way to regulate the single market is to have one independent regulator. Because if you have a regulator which is not fully independent, then every country, all the 28 or 27 countries are going to try to influence the regulator. There's going to be a tough battle between governments. It's going to be a disaster. And so the solution was, well, of course, one could have been, we don't do the single market. But once we decided to do the single market, then it's the equilibrium to choose an independent regulator. Once you set it up like that, I don't think it's easy to come back. We did the same with the ECB, for instance. And the ECB is a fully independent central bank, and we see the benefit of that. We saw it in 2009, and we see it today. So I don't think this is going to change, and therefore I'm relatively optimistic in that specific case in Europe. We saw, I think, a prime example of that in the case of Alstom versus Siemens, which was, if you think about test of my theory, this was the ultimate test, because this was a merger between two train operators and manufacturers of train signaling equipment, one from Germany, one from France, both with very good access to politicians. And the merger was endorsed by both governments, who put tremendous pressure on the commission to clear the merger, even though it was very clear that it was a merger to monopoly and they should say no. All right, so I can guarantee that 20 years ago, things would have been different. But in that case, the commission stood its ground and said no. And Europeans are better off for it. In the background of that, of course, every single other country except Germany and France was very happy for the commission to say no. Okay, that's part of the equilibrium. That's not going to change. If I was, if I was a citizen of Finland or the Netherlands or Portugal, I wouldn't want to be in a single market where France and Germany could sway the regulator their way. That was not viable. So that's the reason I'm optimistic for Europe on that specific front. The second main point that Richard mentioned is, is it harder today to find the right balance? And of course, that question is very much tightly linked to Google, Facebook, and co. So is it harder to find the balance? Yes, for this industry, I think so. But what's striking for me in the US is they managed to get the balance right in some industries that are not that complicated, which is bring me a freaking broadband connection at home. It's not rocket science, or get me a cell phone coverage that actually works. It's not rocket science either. Or airline tickets, that's also not rocket science. So I think that they managed to get it wrong there in industries that are not really the complicated one. So that means they really need to improve. Now, on the complicated one, which is the one with platform and two-sided platform with network effects, yes, it is more complicated. So we need to think about new tools, and I agree with Tirol on that, absolutely. On the other hand, we shouldn't just think of these firms as being utterly different from the past. What struck me when I was writing the book is I went to the history of the top firms in the US since the end of World War II, decade by decade, And if you compare the top 5 firms in the US in the 50s and 60s and 70s and all the way to the 2010s, pretty much the top firms are always outperforming. They always have outsized profit margins. And by this metric, the Google, Facebook, and Apple of today, they are actually not that amazing. They are just as good as every single top firm in the US has been over the past 50 years. And AT&T in its heyday, these were extremely innovative companies. General Motors, same thing. So we shouldn't think of Google and Facebook as being amazing in that sense. They are amazing at a point in time, but they are always being amazing firms in the US. So in that sense, I agree that the regulation is tricky, but we should not treat them as being different from the rest. So these are the 2 main points. Now, the big caveat in all of that, and Richard mentioned it, is China. Because China could upset many of this equilibrium, both on the trade side, because trade and antitrust tend to be linked. You could see it actually in the case of many of the mergers in Europe. And now I hear exactly the same debate in the US, where large lobbyists use China as the main excuse to justify anything. They say, oh, if we want to be able to compete with China, you need to let us merge and build dominant firms at home. So the whole rhetoric of national champions that we need to fight against the Chinese, this has come back big time. And that is a major political economy development that could very well change some of the conclusion I had in the book.
Thomas, can I ask you to come back to this question that I raised in the beginning about competition? Because as one of our colleagues in the Institute for Innovation and Public Purpose, Josh Ryan Collins, argues in his book on real estate and the immense rents and monopoly power of kind of the finance, insurance, and real estate sector, that hasn't been due to lack of competition. It's been due to the characteristics of competitive markets themselves. In fact, he argues that it's free markets and the liberalization of real estate that actually have allowed both the housing boom and the subsequent housing crisis and the monopoly and kind of concentrated power.
By real estate, you mean like real estate brokers?
Sorry?
You mean
the financial sector. Well, if you look at finance in terms of how you break it down, it's not just banks. Again, it's insurance and the real estate and mortgage markets themselves. So something like 80% of the finance in the UK goes back to finance, insurance, and real estate. That has to do with how we currently have deregulated the sector itself. So if you can just bring out, just in your own thinking, I mean, I've got my opinions on this, but I want to understand how you think about it, this issue of competitive versus uncompetitive, and whether it's the characteristics of competition itself and how we define it that have been part of the problem. Similarly, in the tech sector, Tim O'Reilly, who's actually working with us on one of the projects around algorithmic rents in the tech sector, it's not the lack of competition, but the way that the kind of competitive regime itself has managed to allow excess income to be extracted due to the way that algorithms work. So again, coming back to this issue of how production.
So finance,
yeah.
Yeah, so finance and I mean real estate is the real estate impact is more because real estate tend to create lots of debt because it's a hard asset that's created backed by mortgages, and once you issue mortgages, you as a banker, that's a way of making money. So I think that's the main thing. Although I think if I look at the since 2008, if I look at the competition in finance in Europe, I think it's improved a lot. In fact, you can see it straight in the profit margins of banks, which they haven't really recovered. Banking was, pre-COVID, banking was actually quite competitive in many countries in Europe, thanks to many things, from free banking to initiative to deregulate the payment system, initiative to make it easier for fintech to get at to compete with the banks. In fact, it was even getting to the point where I clearly think as a retail consumer, banking is way better in Europe than in the US. It's not even close. Okay. In fact, the US has a terrible banking sector for consumers. It's extremely backward, extremely slow, extremely expensive. In Europe, it's always been relatively efficient, but it was not very competitive. I think it was getting quite efficient and quite competitive actually. So I think on that front, we've done a relatively good job. That was all pre-COVID. The real estate, the big issue is the transfer across generation, but I don't know if that has much to do with finance. With respect to the tech platforms, I think it is an issue of competition. I mean, the question there is more, is there a trade-off between privacy and competition, which these guys want to make you believe? I mean, if you hear the line of defense from Facebook is, oh, if you want us to be able to protect your data, we need huge rents because it's going to cost money to protect the data. So that's the line of defense number one from these guys. I think it's mostly bogus, because if you look at what's actually happened until the point where Facebook managed to get rid of the last competitor, Facebook was relatively okay at protecting your data. In fact, Facebook built its early reputation on being the place where they would respect your privacy and your data better than the others. And then when they managed to get rid of the last competitor in the social network space, that's where they started to renege all of their promises and started to use the data in ways that was not appropriate. So my sense from looking at it is, but to be clear, that trade-off is old. This is the trade-off between quality and competition. This is nothing, it's just relabel the thing, called privacy quality, and that's it. You have exactly the same model, and we know there's a trade-off in theory, but in practice, I think we are on the side of the curve where more competition leads to also better quality in many of these cases. So I don't think there is much trade-off. I think we should just have more competition. The question is how to bring it to these platforms. That's a bit more tricky.
Okay, I mean, maybe I'll rephrase my question in a way that one of the Q&As, and then I'll hand over to Rowan to do the rest. Because you never mention, for example, capital and labor, and yet we're living through, as Richard knows in his inequality review, a period in which the profit-wage ratio is basically at record levels. And so—
No, not in Europe. No, not in Europe. Not in Europe. The profit rate in continental Europe was going down. In fact, the labor share in France.
The profit-wage ratio of GDP in terms of the income distribution in Europe also. I mean, definitely in Italy.
No, it's completely flat.
Europe is very different. Europe is, so I agree with you, but definitely in some countries, including Italy, the ratio of the profit-labor distribution of GDP is, in the last 10 years, at the highest it's been. Let me just read one of the questions, and then Rowan, I'm going to hand over to you to read the others. So Josh, who's written this fantastic book, and he's at the Institute, so I'm going to give him priority, says Thomas's presentation follows a quite standard approach to economic rents, which says that rents are essentially the result of excessive prices above an equilibrium level, in the sense that you compare US with Europe as some sort of equilibrium. The way to reduce these rents is to compete them away. But can we also have stable or even lower prices for consumers, but still very large rents? So for example, the tech companies are the obvious example. What we have actually seen in the last decades is a redistribution of prices towards capital or wealth gains and away from labor and a productive investment. I'm gonna let you answer that, and then I'm gonna hand over to Rowan to do the DJing or emceeing for the other questions.
Yeah, but I think that if you look at the data in details, I don't think it's true that there is an across the board. First of all, it's as a matter of fact, there is no average drop in the labor share, period. The labor share has moved in different directions in different countries. I have a recent paper where we look at 50, 60 years of data for France and a bit more for some other countries. And the labor share in France today, or before the COVID crisis, the labor share was exactly the same as it was in 1960. So I think that then if you look sector by sector, you have manufacturing. In manufacturing, you cannot think of it without thinking about automation, so, which is a different concept, and that has also big implications. And in the service sector, I think if the service sector remains competitive, I don't think there is a reason for the labor share to decrease on average. Now, of course, this still leaves a lot of inequality, because within labor, there's huge differences. That doesn't solve the inequality issue. But I think that if you bring competition to these markets, I mean, that's what we did when we brought EasyJet to France. You know, that forced prices down and margin down. So I think that first order, very simple framework is still the right one in my mind. And the question is how to apply it effectively to the platforms. And clearly revising merger guidelines and having a more forward-looking antitrust approach is required. Yeah.
A couple of things. One, I think being my working through of the labour share that in quite a few countries it has fallen back, even in Germany actually, and Japan. When I look at the figures, it's not precisely my work, and there's probably some dispute there, but I suspect that there's some overall decline, at least in some economies, kind of surprising in Germany somewhat, but inequality rose in Germany as well over that period. So I think there's something in that. At least it's a concern. My own view about that is where you started, Mariana, and others, Aguillon and others, you know, with the Schumpeterian idea. I think that's, if you take, I pretty much agree with Thomas actually, but I would add to it, and I think he would agree, a kind of dynamic side to it, that, you know, what it's about is getting the balance between the payoff to an innovation. If we're just thinking of innovation, not thinking of the direction of innovation, but innovation, getting the kind of dynamics right about this. And we know that's pretty hard to do. And whereas we used to be looking at price cost margins and things of that kind as well, they've become relatively hard. And I think even in telecoms, although you did a great job, you know, as far as the consumer is concerned, the ability to have complex contracts does make it hard to measure prices and compare. So I think there's something going there on the standard measures, and then thinking about how when is it the appropriate time? When are we not really seeing enough entrants, and how should we react to that? So I think all those things are important. I liked Thomas Philippon kind of idea of attention markets, where it kind of fits your kind of platform idea of Facebook and Insta, you know, where you buy two things where there are different groups on different platforms, but then when you put them together, you have, you know, you've got everybody's attention in one place, and that's a point where you can think about exploiting that. And standard antitrust doesn't seem to deal with that. So I think there's some logic to thinking of some digital agency that can really deal with those things separately. And I think there is a concern about the kind of the fall of real wages generally. So I think those two things are things that are driving a lot of people's concerns. But I could go on, but I won't.
See, Mariana, also, if you think about prices, as you were saying earlier, yeah. So the fact that a two-sided platform finds it optimal to have zero price on one side of the platform, this is very old too. You can think of so many older platforms where that was the case, way before Facebook, where one side has, for some reason, usually because it's price elastic or because you want to attract it, or because it's a first mover. You charge zero price on one, you make your profits on the other. That's the business model of many, many two-sided platforms. In the case of Facebook and Google, they charge a high price on the advertising market. Now, the only reason we don't talk about it is because we don't see these prices.
Yeah.
But these prices exist and they are high. And that's got nothing to do with something very complicated. That's high because they have monopoly power on this market. In fact, in some of these, you could even argue they have insider trading advantage because they run the platform at the same time. I mean, the algorithm, I guess it fits right into your algorithmic rants. I mean, to me, the ultimate one is the trading system for ads online, which is completely corrupt with conflict of interest because these guys know the order book and also sell on the same market that they run the platform. So obviously they're going to make money, but that's just a bad regulation.
I guess.
Just a quick question, because COVID is sort of in the background here, and almost every Zoom call I have, like 20 a day, all we talk about is COVID. And I think it's been a bit refreshing that we haven't yet. But one of the big issues right now across the world are the bailouts that are happening across different sectors, from airlines to others, and whether we should have conditionalities. And one of the things that we've been arguing in IIPP and the different COVID task forces we're in is precisely to have conditionalities around these kinds of potential rent extraction activities. I mean, we saw in Denmark just 2 weeks ago that one condition that they imposed was that those companies using tax havens couldn't receive the bailouts. Elizabeth Warren in the US has been saying that those companies using excessive share buybacks shouldn't be bailed out. Just, do we think that a moment like this, which requires both an urgent attention to lives and helping kind of cash flow, help businesses remain stable and not go bankrupt, could also be an opportunity for reducing rents and monopoly power? And what do you think about that? Both of you, actually. I'd like to ask you that.
I think it'd be good.
A lot of
I think it'd be good if we managed to avoid an increase. I don't know about reducing it, but I think clearly, given the death rate of small businesses and the fact that the big ones are always better at getting bailed out and also can tap into different markets to get funding because they have bonds and loans, there is a danger for higher concentration post-COVID. It's clearly going to happen in some industries. In some industries, it's going to be required anyway. But we should avoid an across-the-board increase in concentration. There is a bright side, though, as Richard pointed out earlier. Slack and Zoom, these guys are going to be competitors with Google and Facebook pretty soon, and I think that's good news for everybody.
I'm going to start with the questions around concentration. So from Yorgos, I can never say his name, Guzoulis. The first question is there really good concentration, specifically regarding the example of retail and wholesale trade? Usually low prices and high productivity are due to low wages and the emergence of global value chains. Thus, is price efficiency a good way to measure economic efficiency? Shouldn't one examine whether rewards correspond to contribution to value creation? I'm going to follow that up with a second question on good concentration from Maria Savona. I wonder whether the good concentration should be revisited by taking into account wages. You mentioned that consumers gained via lower prices, but retail and wholesale of such giants have kept wages really low. These are the services that are essential in pandemics, by the way. Also, returns on intangibles are based on data appropriation. In sum, I think that alongside bad or good concentration, we should be worried about good or bad, our unknown business models of dominant firms, notably tech giants. Can you guys all concentrate on good concentration? Who'd like to go first?
Well, I think to a first order that yes, my answer is I want to stick to the old-fashioned definition. I want to focus on prices. In the case of Walmart, I do discuss the issue of minimum wage, but I find that it has a very small impact on the efficiency. And the reason Walmart charges low prices is because of productivity, not because of lower wages. I think the only caveat is that we have evidence in some markets in the US today that if you have very few employers in town, you could have a comeback of monopoly rents, which is when exactly firms have a local monopoly or monopoly on the labor market and can charge lower wages. I don't know if Richard thinks that's an issue in the UK.
Yeah, that's good. And we worry quite a bit about exclusivity contracts, by the way. They become highlighted in COVID, where people can't work for other companies. There's kind of good reason for that, but there's some issues around that. I think the kind of retail thing is an interesting one. I wouldn't just put on I wouldn't just put it on wages. I would put it on supplying industries too. You know, the richest person in Spain is the person who owns Zara, and one strategy they have clearly is on the price, the cost of supply. And we don't fully understand that. I'm not saying there is a problem there, but I think the issues around a large companies dealing with the inputs and the prices of those is key. But I agree that I haven't found much evidence of monopsony in those industries either. And I think perhaps where there's another thing going on, and that is the way their technology is lined up. They don't have much incentive for wage progression or human capital investments. That's just the way the business operates, the technology of retail now. And I think that is a problem. I think at the bottom of the distribution, you know, in my own view, the problem of inequality is one of progression, that you just don't see anything going on at the bottom, and that gives kind of despair. And I think there's something in this. But the first question, I always thought it's logistics were the key. You know, Walmart reinvented logistics, and that's what Audi's done. And that's really, you know, that was a really impressive innovation. And I think that's, you know, that's where the return has come, really.
I mean, when I think of Walmart, I think of the comparison with its main competitor, who's Costco. And they have often had the same profit margins, but due to very different types of innovation. There, you know, for a long part of Walmart's history, when you got a job there, you could at the same time apply for welfare benefits because your wages were going to be so low that you would also be able to get state handouts. Whereas Costco has always been very much about innovating and reinvesting profits back into ways to increase the profit margin through the actual production structure. And I just want to come back to this notion of production, because if we go back to Schumpeter, as I mentioned in the beginning, compared to Ricardo, he actually said different things at different moments of his life and thinking. In the beginning, he really kind of obsessed about, you know, small companies and this kind of entrepreneurialism way that often policymakers today talk about SMEs. And then later in life, in his book, Capitalism, Socialism, and Democracy, he worried actually that in order to innovate, you actually had to be quite big. You might need a large R&D laboratory, and that often was, in fact, synonymous with being large and potentially monopolistic. And if we look at different sectors, what actually matters is not so much about small companies, how many of them are, or large companies and their concentration ratio, whether it's Herfindahl or anything else. It's how and whether they're abusing their power over concrete different issues, which we can as policymakers govern, or not we, but anyway, policymakers can govern better. So just taking, you know, the patent system, Richard Nelson at Columbia University has written a lot about this. Currently we have allowed, and there's no reason that we should do this, it's not deterministic, we've allowed patents, for example, to be too wide and too strong, whereas actually what determines what I mentioned before that William Baumol talked about in terms of productive, not unproductive entrepreneurship, was the ability also to govern the patent system in such a way that patents were both more narrow and weaker, and that would actually stimulate the kind of innovation that Schumpeter talked about. So I just think that we need to go back to this governance question, and the policymaker is not just there to kind of, you know, reduce the size of a company or to reduce price cost margins, but really to govern the system to actually create the kind of innovation and reductions in inequality that in some ways have been in the background of what we're talking about, but that requires an immense amount of policy. And we shouldn't forget that Adam Smith himself, when he talked about the free market, he actually meant free from rent, not free from the state, as the kind of bogus Adam Smithians, advocate.
I think you segued nicely into the next set of questions, which there were a little flurry of questions that located their concern around the firm. So I'm going to start with Claudio Fernandez from Brazil, and his point around, while commenting on your excellent presentation, Thomas, his point is, although we economists really need to get into the mix, a thought we need to get into the mix is the concreteness of power relations as a determinant in four senses: prices, wages, profit margins, and politics. Beside the financial gains, also need to be in the mix a strong determinant on investment and innovation. Big Pharma invests much less on R&D than on marketing. Microsoft has the power of public contracts around the world, but does not innovate, just buys in the innovators and other asymmetries as such. I'll follow on from that comment, three quick questions. Thomas focused on market structures and evaluating competition, i.e. external factors. Shouldn't we be evaluating competition in terms of firm conduct? Are firms coercive, deceptive, or do they give incomplete or confusing information? That's the first question. And then from Prabhu Kaptara, your explanation for why the EU moves forward in free markets is clear. What is not clear is your explanation for the move towards less free markets in the USA. Yes, lobbying expenditure rose. Yes, barriers to entries were allowed to rise. And yes, predatory behavior in tech and health were tolerated. The question is why? And then finally, it's all sounding very, a bit conspiracy theory, but hey, from Jonathan Cooper-Smith, we have, does clever lawyering to avoid taxes and pitting governments against each other fall under lobbying, or is it a separate category? If the latter, is it as detrimental as lobbying? So those are three questions that are located on the issue of the firm. Who would like to jump in there?
So on the first one on firm conduct, yes, I mean, I think we should, so clearly firm conduct is regulated by laws that should be enforced. So we have laws against cartels, against deceptive practices, against deceptive commercial practices, and all of that. I think that's very clear. And they should be absolutely enforced. The question is whether, if you bring in more or less competition, whether that's going to interact with that. It's a little bit what we discussed earlier. And I think my reading of the evidence is that competition is also a way of keeping their companies on their toes. The reason is very simple. It's just competition gives consumers the choice. So if you feel a firm has misbehaved, the best thing you can do, like if you're in the US, if you're pissed by the quality of your cell phone carriers, well, the ideal thing would be you could switch to another one, but they're all the same and they all charge crazy prices. So you don't have a way of exiting. In Europe, if you don't like your carrier, you can switch to another one and they know the threat, therefore they behave better. I think that is the main virtue of competition. For the second question on the US, point well taken. The truth is, I don't know. I have a good theory for Europe. I know exactly what happened in Europe. I can write the model, in fact I did. For the US, I don't. All I can see is proxy causes, and I don't know if something changed in 2000, or it was just an accumulation of factors. Clearly, 9/11 had a huge impact on the political system in the US. It had a direct impact on the airlines, so it launched a big merger wave of airlines from 8 down to 4. It also had large political economy consequences. It's maybe not by coincidence that the last attempt to try to have some regulation of campaign finance by McCain and Feingold was right after that, and it failed. So something happened around that time that led to more political power by corporate lobbyists. And I don't know the deep explanation.
I think the lobbying thing, I know Mariana didn't want us to discuss that, but if you look at the growth in expenditures and just take Google in its own right, I think that's there. I do think they got, I know you've always been able to do a killer acquisition, but I was quite taken by the way you can manage to acquire firms under the radar, and maybe that's increased. I don't know. It's a good question. We know it exists now, small but important part. So I think that's the kind of US. I didn't mention so much on all these policies. I think coordination for firms, and especially firms that go across jurisdictions, are really able to play the game here. And I think we've learned that in taxation, and we haven't responded very well. the EU tried to and does a potentially good job, but not wonderful. Think of Ireland, Netherlands, the crazy patent boxes, all those things. That's just, we haven't been very successful. And in a sense, Thomas' argument was the EU was successful in competition policy across national jurisdictions, quite impressive. But still, these companies go much wider than Europe. And I think there is an issue, especially as we come out of COVID, of playing one jurisdiction against another. And that's always a game that larger firms can play. And so you do feel that the room for coordinated policy is very, very important here. And yet I think the political will for that is probably weakening.
Yeah. I'm not sure where you got the notion that I didn't want to talk about lobbying. I love talking about lobbying. I just always relate it to what's happening on the production floor.
I understand.
So, yeah. So one of the things that always made me curious about Piketty's book, when he looked at the increase in inequality from the 1970s onwards, is you could almost go decade by decade, or even 5 years within that decade by 5 years, and look at the lobbying efforts that occurred also in terms of the narratives, which we haven't really used that word yet, but the narratives of where value actually comes from. So the decade in which in the US, the capital gains tax, which Piketty talks about, fell by 50% in 4 years, occurred by massive lobbying within the finance sector, specifically within private equity, and even more specifically within the venture capital sector, which had just formed the National Venture Capital Association, this idea that they somehow needed capital gains tax to fall immensely in order for them to create value. And I think this is just something we haven't talked about yet, and we'll surely talk about in the future seminars of this type, which I'll say something about in a second in the closing, just how tax itself and the details about tax, and Richard just mentioned the patent box, which the IFS, Institute for Fiscal Studies, which he has directed the research for, has been one of the greatest advocates for understanding the unproductive role that something like the patent box has, which in Europe, by the way, is spreading like an oil stain. And that only increases profits. It doesn't increase investment. The role of policy is not to increase profits, but to really catalyze the additionality, making investment happen where it wouldn't have happened anyway. But these don't happen in a vacuum. They happen through lobbying, and lobbying is also about storytelling. Rowan, if you allow me, I'll just close, because we're very grateful to the Midyar Network, who have just financed for us a whole project on this notion of algorithmic rents, which we've just touched on casually in this conversation. But part of that will be a whole seminar series that we will be running for the next 12 months on this notion of really understanding how rents and monopoly power is extracted and created in sectors that have to do with how production and competition actually work at that level. So we will be looking at the pharmaceutical sector, so the health sector, which of course under COVID is immensely important, but also at the tech sector in terms of the digital platforms. We'll be looking at finance, as well as the real estate sector, which again, I mentioned my colleague Josh Ryan Collins have worked on a lot. So we hope that the full 300 participants who joined us in the beginning will be joining us throughout that. And thank you so much, Thomas, for a brilliant book and presentation that you gave to us tonight. It was amazing. In 20 minutes, you summed everything up so eloquently and dynamically. And Richard, for your excellent comments, and especially for the work that you're doing in the Deaton Review, which is really trying to get to the sources of inequality. So thank you to everybody who's stuck in there. And buy Thomas's book. And please stay tuned to the Deaton Review's work in inequality and the work that we're doing in the Institute on bringing purpose back to the center of political economy.